Hey everyone, welcome back to the Market Stalkers channel. My name is Dee and I've been trading futures professionally since 2013, but I've actually been trading independently since 2008. So I might know a thing or two. Today I'm going to talk to you about the proper use of poor highs and poor lows, which is a concept taken from the market profile strategies, which is something that I use on a daily basis. And I have done ever since I went into professional day trading. But before that, I just want to get some stuff out of the way. We have a pretty cool deal coming up for Halloween, because let's face it, there's nothing scarier than trading without enough knowledge and skill. So here's a chance to save a bit of money. We're going to have 35% off on almost all pro development program membership levels, which is on the main site. You'll find a link down below. With that out of the way, let's get into the subject of today's video, which is how to correctly use poor highs and poor lows. Now, poor highs and poor lows, they're a concept taken from market profile strategies, which is something that I've been using every single day for like 10 years with great success. So for this video to actually make sense to you, of course you need some familiarity with market profile. Now, first off, what are poor highs or poor lows? Well, they're kind of like an anomalous market structure where the TPO profile ends the day with 2 TPO letters per row, either at the very top of the profile or the very bottom of the profile. So 2 TPOs in one row, like a weird little structure, right? So what does that mean? It usually means that the move ran out of steam. But you may have noticed that I rarely mention these on my live streams that I do every single day right here on YouTube for our YouTube members. And that's because I'm not a big advocate for using poor highs and lows as a solid strategy for a couple of reasons. The first reason is, well, poor highs and poor lows are extremely rare. And the second reason is that the real valid poor highs and lows need to only be considered after a trending day. So considering that real trending days only happen about 30% of the time anyways, then when you take like a couple of years into consideration and then you observe how many times this happens, you'll actually find that the trending days are not that frequent. They're an anomaly. So you're already working with an event that has a probability of generally happening about 30% of the time. And then out of all of those trending days, how many of them end up having poor highs or poor lows? But here's the thing, they do happen. So why are they important? Well, they're important because when they do occur, you might have this high probability thing that happens the next day, which is price going even further, going through the poor high or a poor low. So how do we take advantage of that? First, you need to have a look at some details, because details are frequently missed by a lot of folk. The definition of it says the next day has a higher chance of going through poor highs and lows. The next day, not the same session, not the same day. So right away, that means you have to have a finished profile, not the developing profile where you still don't know if the poor high or poor low are there to stay. So one way to use this as a strategy is to find the setup the next day with the direction of the poor high or poor low. In day trading specifically, finer points and details on setup definitions are frequently neglected. So why do proper definitions matter? They matter because you want to use all of these profile strategies in their true powerful form, as they were observed and quantified for statistical relevance by Peter Steidelmeier and then popularized by Jim Dalton. And hopefully now us, a group of market stalkers, so it's not just me, it's a whole bunch of people, who went even further to test what still works in current market conditions and what is not working anymore. That exploration of what works and what doesn't, that's what our Market Stalkers Pro Development Program is all about. If you're interested in that, there are links down below this video with a lot more information, so I'm not going to go into that right now. Let's move on to how to use poor highs and poor lows correctly. So just one more time, for good measure, let me remind you what they are. They happen when a trending move runs out of steam. So right away, there's another detail that loads of people miss. a trending move. Not any old day, not any time that you just randomly see two TPOs finishing the profile and going poor high. So without a trending move, without the extension of the initial balance, there cannot be a poor high or poor low. And in fact, many ranging days, boring responsive days, where the price doesn't really do much, you will have two TPOs at the edge of the profile. But it's not a trending move. Ergo, not a poor high or poor low. Details matter. So really, in order to get a valid setup, the next day, you must have had a strong auction that left single prints on the way up or the way down after that initial momentum. And then, eventually, throughout the day, you notice a poor high or a poor low getting created and the day ends, the session ends. So it basically happens when the move just runs out of steam, kind of hits the ceiling or a floor and just stays there. So the market participants might have tried to go further, but there was no one there to keep taking the orders. So on that first day, when the poor high or poor low appears, you can actually attempt an auction fade to go against the poor high or poor low. Why? Because the auction ran out of steam. Obviously, the danger there is that it's not actually a true poor high or poor low, and the market continues even further. Okay, there's always a risk, right? Everything is risky in day trading. That's why we have probabilities and statistics. Now, the next day, if that poor high or poor low stays on the previous day TPO profile, you might see that high probability event of the poor high or low getting taken out. But then there's like a little bit of a misconception there as well, that this break of the previous day poor high or low will bring yet another strong trending day. And on most occasions, that's not going to be true. In fact, what might happen is that the market goes through the poor high or poor low and then reverses or does nothing for the rest of the day. So if anything, this is not some kind of a swing trading strategy. It's actually a scalping opportunity to go through those poor highs or poor lows and then to look for another setup that doesn't take poor highs or poor lows into consideration. Now, because of all of this, because of the general low occurrence of this event, and out of all the other available trading strategies that actually do happen on 70% of the days, and then combined with a ton of people who are jumping the gun and then calling the poor highs and poor lows when they're not properly defined, I am no longer teaching the concept of poor highs and lows in the program because, in my opinion, they're just not worth it. You will be just fine not having the poor highs and poor lows as one of your entry tools and setup tools in your entire trading toolkit. If you want to develop real consistent profitability, you cannot focus on the rare anomalies. Instead, you need to learn about the norms that happen nearly every day. Now, that's where the money is in day trading. Being able to repeat something day in, day out, 2 to 3 times a day. If you want to know more about how to correctly use some of these market profile isolated components, then you might also want to check out my video on how to use the value area properly right here.